Well, hello and welcome to everybody to today's webinar on energy economics, finance, and investment impacts of COVID-19. We're thrilled to have three speakers today for a discussion about how an industry as capital intensive as the electricity sector has been moved by this global pandemic. We'll be joined today by Richard McMahon, Senior Vice President for Energy Supply and Finance at Edison Electric Institute, Dave Turk, Acting Deputy Executive Director at the International Energy Agency, and Lawrence Jones, Vice President for International Programs, also at EEI, will be our moderator. So if you have questions that you would like to ask to any of the panelists or a comment that you'd like to offer, you can use the chat feature in order to submit that to us, and we'll do our best to feed that into the discussion. So Lawrence, I'll turn it over to you to get us started.
Thank you, Daniel, and good morning, everyone. Welcome to this webinar. We're very glad to have a conversation this morning about the issue of energy economics, finance, and investments as it relates to the impact of COVID-19 on the energy industry. As you all know, the industry has gone through a lot, as have other industries as a result of this pandemic. And one area where we know there is very, very much interest is how the economics is going to play out over the next couple of years, but also in the immediate term. This morning, as Daniel indicated, we'll be hearing from two speakers. The first will be Richard McMahon. Richard is the Senior Vice President for the Edison Electric Institute. And Richard and I, over the last couple of months, have had numerous conversations around this issue of the economics of COVID-19. And Richard and his team have done tremendous work in terms of not just trying to dig into what's happening in the US, but also every year we annually give out a financial outlook for the industry. And Richard will talk a little bit about that. When Richard is done, we will entertain a few questions to him on his presentation. That will be followed by Dave Turk. Dave will be joining us shortly. And then when Dave is done with his presentation, we'll move forward with a few questions and then have a general conversation with Dave and Richard on this issue of energy economics, finance, and investments. So Richard, over to you for your presentation.
Thank you, Lawrence, and good day to everybody. I hope everybody's well. It's really a pleasure for me to be with you today, and with Dave, Lawrence, and the EEI team. We have a long partnership with IEA and really admire their mission, bringing together businesses, governments to really help to define what the sustainable energy future it will be. I'm going to talk to you mostly about what's happening within the United States in the electric sector. First, I'm going to give an overview of sort of the pre-COVID-19 industry financial and CAPEX picture. Then I'll talk a little bit about what COVID-19 impacts have been on the electric sector so far. And it's gone for about, again, we're about a little over 3 months in. And then I'll talk finally about what the sort of outlook will be in terms of economic, financial, and the capital implications, particularly CAPEX. So first, the industry was in strong financial health prior to COVID-19. Looking at stock performance, our stock performance on a 1-year, 3-year, 5-year, and even 10-year basis was very competitive, and we were attracting capital in a very successful way. Looking at dividends, our dividend yield was about 3%. Almost all of our companies were paying a dividend. In fact, most of them, the United States investor-owned electric utilities, increased their dividend in 2019. And then looking at credit, we were a strong BBB plus average, and the outlook for the industry was mostly stable or positive. So very good conditions for the capital program and the expansion that we're in. So looking at our capital spend, really, we have been on an elevated capital spend for the last decade. And if you consider year over year, really starting in 2010 forward, we've almost been hitting year over year record spends in capital. And then to the point where in 2019, the number was 135.6 billion. And to give you a sense of the impact that has had on the industry, that's taken our industry from about a $750 billion industry to a $1.3 trillion industry with a T in 2019. And just looking at this graph, the one thing you need to bear in mind is that this sort of bell shape where you sort of plateau and then go down in the following years. That pattern we've seen since 2010. So we really were on a trajectory, we believe, to continue that year-over-year capital spend, because frankly, it's helping us and the industry in their leadership role in sort of transforming, to the lower carbon energy economy, the things that the industry is doing along those lines. Next slide. So this is the look at the sort of capital allocation within that spend. The one thing of note I'd say is that early on in the capital spend, there was much more focus on generation. Generation was a larger piece of that spend, and that's really a function of the fact that we had really been doing a lot of capital stock turnover, tremendous amount of coal to gas switching, tremendous amount of investing in renewable energy. And as we get closer to 2019, we're seeing that capital allocation shift a little bit more toward the T&D side of the business. And that's really a reflection of the fact that we're doing resiliency investments, hardening investments, also smart grid related investments. And so those are sort of an explanation of why the shift has taken place, but still that trajectory was continuing through 2019. Next slide. Next slide. So then the pandemic hit, and this slide really gives you a sense regionally. Back up one. Just go to the prior slide, please. This slide gives you of the COVID-19 and the subsequent really shutdown of a lot of the economy associated with the pandemic. Quite a bit of differences, and part of that is really a function of the fact that commercial industrial load was really a driver in some of these demand differences and exposure to that, as well as obviously weather conditions and other things that we normally see. Next slide. This slide really shows you sort of on a weather normalized basis, just looking at historic trends, and really puts into context what the impact of COVID has been on the industry. Absolute output in the last 13 weeks is down about 4.3%. Not a huge amount. And if you really look at it in the context of where demand was and output was over the last several years, we've had relatively flat demand. And so this is off of that trajectory of relatively flat demand year over year. And again, one of the things to highlight in this sort of S-wave chart that we have here is that if there's anything that was sort of a positive aspect in terms of the electric business, in terms of the timing of this pandemic, it's that it occurred during a traditional shoulder season. And that's a season when basically electric demand is almost naturally down. And so that's what we're seeing here. We're starting to come out of that obviously right now as we enter into the summer season. And that's when obviously electric load picks up because of air conditioning and so on. But if there's any sort of mitigation to the fact that it's the fact that it occurred during that shoulder season, during the spring months, when traditionally electric load is down. Next slide. Now, this will give you a sense, harkening back to the earlier slide that showed the geographic differences of the impact. As I said, a lot of the impact is being felt on the commercial industrial side, because really what we saw when the economy shut down was a tremendous shift between commercial industrial to residential because of this really massive shift that was really enabled by the electric industry to enable telecommuting in a very significant way. I mean, this webinar that we're having today is a function of the fact that we're mostly working from home in remote locations. So if you really want to look at the impacts, you really need to look at the commercial industrial impacts. And so where these industries, like for example, gaming, in those regions of the country, harkening back to that prior map, will show were hit pretty significantly because of the fact that many of those industries that rely on tourism or large gathering in groups of people were hit hardest. And so this chart really does a nice job of sort of laying out industry by industry and then looking back at the geographic impacts. It really does a lot to explain why we experience what we experience with respect to demand in different regions of the country. Next slide. So big picture, given these reductions, what are the levers that the utility industry has to address these impacts on demand and sales? Well, there's basically three major levers. And I think what we've seen predominantly is it's being dealt primarily in the first lever, and that is managing operating and maintenance costs and reducing those costs. There have been a few examples, and I'll describe them a little bit later in the presentation, where some companies have they haven't lowered CAPEX, they've actually deferred CAPEX. And I think that, that the next step would be cancellation of projects and things like that. We haven't seen that at this point in time, but we have seen a lowering of CAPEX. So in some cases, not all, in some cases. And then finally, reducing dividends or changing a dividend policy. And that's usually a very negative, has a negative impact on cost of capital, access to capital, and things like that. So that's usually not the approach that you want to take in a scenario where you have reduced revenues or demand is down because of something extraordinary like we're seeing today as a result of COVID-19. Next slide. Interestingly enough, we just saw some information from Wood Mackenzie. And, we, as I said, on the generation side, we had been on a very strong trajectory in terms of capital stock turnover on the fleet, tremendous amount of investing in natural gas, but also in renewables, and particularly solar and wind. And that trend is going to continue even in the face of the pandemic. Wood Mackenzie just released some information that shows that solar CAPEX is expected to increase 33% in the U.S. this year over last year. And that's mostly driven by utility scale solar increases of over 14.5 gigawatts. In fact, I believe the rooftop applications are actually down. So it's really driven by a utility scale solar application. That's a real positive, that trend. Looking at energy storage, and I will note that in the U.S., the utilities are the predominant, deployers and, spending the most on CAPEX in terms of solar energy. Same goes for energy storage. Energy storage capacity is expected to grow by 1,185 megawatts in 2020. That's down from the pre-COVID projection of 1,452 megawatts. However, if you look at the year-over-year comparison, it's still a record year. So what we're talking about in energy storage is that the applications of energy storage would have been an even higher record year over year, 2019 to 2020, but it'll still be a record. It just won't be as high a record. So those are really bullish indicators, I think, both for solar and storage. And these are both very important technologies as part of this transition of the fleet and the transition to lower carbon energy economy that the utilities are leading. Next slide. So just a word about the major rating agencies. As we mentioned at the beginning, our industry, the electric utility industry in the U.S., is the most capital-intensive industry, and therefore ready access to capital markets at affordable rates is critically important for our industry. And I think that the good news is that even in the face of the COVID-19 pandemic, our ratings remain, for the most part, two of the three major rating agencies have the outlook as stable for the industry, and S&P, only the outlook has changed from stable to negative, but and that's mostly because of where the average industry credit rating is, a BBB plus. Their thought was there was not as much cushion as there was being at that average rating level, but I think that generally speaking, the outlook for the industry is stable. And so I think that's a real plus as we navigate our way through this pandemic. Next slide. So looking at our, our equity side, I think it's a very similar story. I think one of the real positives for the industry that we've seen throughout the pandemic is that for the most part, our industry has been able to sustain access to the capital markets. And again, as the most capital industry, we need ready access to capital markets. And that has been there throughout the pandemic. There have been some hiccups in certain aspects of the short-term capital markets like commercial paper, but those have sort of corrected themselves with federal intervention at the Fed and the Treasury and so on. And I think even those markets have stabilized. But even notwithstanding that, our industry has been able to maintain ready access to capital markets and has sustained their liquidity throughout this period. And essentially, this is what how the Wall Street analysts are looking at it from a sector valuation standpoint. Our shares are still what they would call a defensive pick due to the low earnings volatility, the regulated returns and dividends. And I think that those trends are looked to continue. Obviously, the analysts are looking at how the state commissions are going to look at issues around these uncollectibles and the costs associated with sustaining service throughout. And again, as a lifeline sector, I think that's been one of the incredible feats of this industry, has been to sustain its service throughout the pandemic, enabling this transition that we were talking about earlier. Again, same thing as earnings. I think that we had talked about the levers that utilities have to sustain their earnings. We're seeing an awful lot of work done in terms of O&M and cost reductions, things like that. And I think the question mark is out there is that what is the scope of the bad debt exposure going to be? And what are the regulatory mechanisms going to be put in place to help recover those bad debts associated with this unprecedented shutdown of the economy associated with the pandemic? Next slide. Moving on to the next slide. Thank you. One thing I do want to mention is ESG. I think many of you know that EEI has put in place an ESG, environment, social governance template. It's the first sector-specific voluntary template. It's been adopted by all of our members. We brought AGA into it. Their members have adopted it. But our industry is really an ESG positive industry. Obviously, when most companies look at us, they're looking at investors, they're looking at the environment piece. But I think that one of the aspects that's really been highlighted throughout this pandemic is the S and the G piece in terms of the way that our companies have responded, sustained the lifeline service in the face of these challenges, put in place, for example, a moratoria on cutoffs for customers that got into arrears on their payments. I think those were really, from a societal standpoint, highly impactful and really important, and shows the leadership that the industry has on ESG. So I think that those aspects of ESG, obviously led by the environmental piece and the transition that we're leading in terms of the movement to the lower carbon energy economy, that coupled with the aspect of the governance aspects of dealing with this pandemic, addressing worker safety and those issues, and then the societal impacts of sustaining service and putting in place a voluntary cutoff moratoria. All of those things bode extremely well for the industry in terms of ESG, which is very important to our investors and society generally. Next slide. So we talked earlier about the perception of the rating agencies and the analysts on Wall Street about the risks of the industry. And obviously, it's a regulated industry. And so this chart highlights the fact that as of June 18th, 26 states and the District of Columbia are addressing this issue of cost recovery associated with bad debts, deferrals. These include regulatory mechanisms such as trackers, creation of regulatory assets, and other tools that the regulators have in their toolkit, working with utilities to address these profound, issues associated with this unprecedented shutdown in the economy and the way our members responded. So very positive regulatory environment, a lot of discussion and dialogue going on throughout the country to address these issues. Next slide. So I'm going to close with just a discussion about what the industry priorities have been during the COVID-19 period. First and foremost, I'll start with the customers. The customers were really at the heart of this discussion when the economy shut down and pretty much all office workers, most office workers, changed their businesses from working in office buildings to working out of their homes. Having reliable, affordable electric service was critical, and our industry responded to that challenge with flying colors and sustained service throughout the period. We are obviously looking to help customers through the federal programs. For low-income customers, there's a program in the U.S. called LIHEAP. We're looking to increase funding for that. And for the commercial industrial customers, as I mentioned, who are impacted really very profoundly through this crisis, there's a program that the Fed and the Treasury are running and the Small Business Administration called the Paycheck Protection Program. And there's other stimulus programs too. And even though they don't directly impact us, our industry has been really supportive of those programs for our customers. And then obviously the maintaining and sustaining operations was critical throughout this period, but also the only way to do that was to ensure the safety of our employees. So EEI set up Tiger teams working with our companies to identify best practices to sustain these services and to ensure the safety of our employees. Also, there's a government industry partnership called the Electric Subsector Coordinating Council that EEI and our member companies participate in at the highest levels. And then finally, and equally important, sustaining the financial health of the industry. I talked a little bit about our activities to address the liquidity issues that occurred in the commercial paper markets at the very beginning of this crisis. You saw sort of an activity where, you had the investors all sort of moving to cash. And so, that aspect was had the effect of really sort of seizing up the paper markets. But the Fed had a program called the Commercial Paper Funding Facility that they had in place in 2008. They reinstated that along with some other programs, and ultimately that brought liquidity back to that market. But utilities had other levers that they could go to sustain their liquidity, which they did do. We're also looking for activities to smooth pension funding, which because of the fact that the Fed reduced the risk-free rate very significantly down to almost zero, that had an impact on funding for pension liabilities. And so we're looking for some relief there with industries more broadly. And again, we talked about the bad debt recovery that's taking place at the state level. And generally, because the industry stepped to the plate with the voluntary bad debt collection moratoria, we don't like the idea of federal states and the companies to work through those things. I do want to mention, because I mentioned it very briefly, there's a question about what Tiger teams are. Essentially, at the very beginning of this crisis, because our industry has such great, really excellence in terms of working together to address storms and cyber events, we have a mutual assistance program that is a wonderful program that enables companies to help one another, and EEI is very active in that activity. Because we saw some very unique aspects to this pandemic, we established teams to address the particular aspects of that, and we asked each company to identify a special point of contact at the company, and therefore we had somebody that at each company, each member company, that could participate with EEI and work together to address the challenges that were very distinct and unique associated with this pandemic. For example, ensuring that there's sufficient PPE for workers at power plants and workers that were doing mutual assistance to help restore power in storms and those sorts of things. So that's an example of what the Tiger teams worked on. Lawrence and I have a colleague at EEI that really leads those efforts, and at some point you may want to hear from him, but it's really a tribute to the industry that we not only, that our industry really and our linemen and all of the people in our industry work together throughout this crisis to sustain service, but also we pull together and share best practices. So that's what that is about. with that, I'm going to close out and turn it back to Lawrence.
Thank you, Richard. So let's just take a few questions before we turn it over to Dave, who should be joining us here shortly. So, Richard, what I found interesting was the slide where you talked about the IOU sector in terms of CAPEX. Can you talk a little bit about what has made it possible for the U.S. IOU industry to have that sort of a sustained CAPEX investment over the last decade? What were some of the drivers or some of the measures that were put in place so that other countries that may be looking at attracting investors to make this kind of a robust investment in infrastructure over a decade? What were some of the drivers, and what were some of the environmental issues that, when I say environmental, I mean economic environmental
Sure.
issues that made it happen? Can you talk a little bit about that?
Sure. Well, I think that first and foremost, I think the leadership in the industry. I think we have, the leaders of our companies are, a really excellent group of CEOs, and they have a vision, and they had really, they articulated a vision, and working also with EEI and Tom Kuhn's leadership, that vision for a cleaner energy future really took hold within the industry. And I think that that is also what led to, the strength of our ESG program, is the fact that, the companies really had that vision for a clean energy future. And then also working, the member companies working hand in hand with regulators and other stakeholders to, really on that vision and what needed to happen in order to bring it about. So I think having a positive regulatory environment, engagement with customers, having a vision, and then pursuing that vision on a consistent basis. I mean, I think one of the things that's been interesting about this is this trajectory that we're on really hasn't changed that much over the last decade. Again, it reflects the arc of that capital spend. This trajectory has been ongoing, and I think that it has evolved in different ways. As I said, it's early on, it was much more focused on generation. It still has a very heavy generation spend, as we talked about, but it's now really focused on other issues like resilience and hardening, and some of those issues, and cyber hardening, and some of those issues that have more come to the fore more recently. So this is an industry that is really has a long-term strategic vision, works with the regulators, works with stakeholders, works with customers, gets buy-in, and then gets consensus, and then goes about implementing that vision in a strategic way. And I think that's why it's been so successful. And I think that's why, another reason why you're not going to see maybe, there has been discussion internationally. I know Dave's going to talk about it, about the drop off in international CAPEX. I know I recognize that there's a lot of oil and gas driving that, but I think that's why we're maybe on a different path than other parts of the world.
So you mentioned the issue of ESG, and I know you and I have had conversations over the years about this whole issue around adaptation and mitigation in the context of climate. Can you talk a little bit about adaptation and mitigation from the standpoint of resilience, in terms of how it's being viewed by investors and what role EI is playing to sort of push on the resilience investments, but also talk about the issue around mitigation and how that's important?
Well, I think in many respects, however you call it, you could call it adaptation, you could call it hardening or resilience. We call it all three: adaptation, hardening, and resilience. There's been no question that our companies have been really leading the way in that capital spend really over almost the past decade. And I think particularly over the past 4 or 5 years, where you've seen that shift between generation spend and T&D spend, because a lot of that investment, raising transformers, undergrounding lines, hardening the system, putting in place cyber protections, those sorts of things, really have sort of come to the fore over the last 5-6 years. And so that's why you've seen that increase there. And then I think there's a real recognition that it's yielded benefits. I mean, if you look at the response of our companies, not only do we have an excellent mutual assistance program and a sharing that goes on, but just because of this technology, the response has been incredibly good. And I mean, I think the other side of this from a cyber standpoint, the fact that you've really had no major cyber events, notwithstanding the fact that the industry is a critical industry that's exposed to that risk, that really speaks volumes. But from a storm standpoint, from a weather resilience standpoint, I think you've seen tremendous improvements off of a good record to begin with because of the mutual assistance. A lot of improvements because of the technology, because of the hardening and the investment that has been made over the last 5-6 years. So it's really yielded great results.
Well, so on the issue of resilience, though, Richard, can you talk a little bit about how regulators in the U.S. have been responding to the need for utilities or electric companies to invest in resilience and making sure that those investments are sort of factor into the overall regulatory framework? Can you talk a little bit about that?
Yeah, I think there's I think there's a consensus view. My feeling, a consensus view about ultimately that we want to see the customers get affordable, reliable, and sustainable service. And, in light of the fact that we've had a lot more severe, impactful weather events over the last decade, I think the recognition is that that kind of spending and because of the utilities' ability to deploy capital in a very cost-effective way and access capital markets at very affordable rates, and the regulatory relationships, I think utilities are best suited to make that capital investment in a way that has real positive and almost immediate benefits to customers. So it's really a virtuous cycle there where these investors, the customers benefit, the system from an environmental standpoint is more sustainable, and it's done in a way that doesn't cause rate shock, where the rates are sustained and affordable for customers. So, that's the balance that needs to be maintained. And I think that the partnership between our companies, regulators, stakeholders has really yielded that really virtuous cycle that we've seen.
A few more questions, Richard, for you, and then we'll switch over to Dave.
Okay.
Just talk a little about the ESG. How did EI go about bringing together this template that has now taken off, with it being adopted by other sectors, and we were seeing even some of EI's international members also adapting or beginning to use this whole template. Can you talk about how it went about creating this framework?
Sure. Thanks, Lawrence. Well, we're really fortunate at EEI in that we have, because of the capital intensity of our business, we have ongoing dialogues at EEI with the Wall Street financial community. We have great leadership there. And I think that because of that discussion, we were able to identify early on, almost 4 years ago now, how important ESG was going to be just generally as an investment trend, as a priority for the biggest institutions. So we identified that trend very early. And we're also fortunate in that at EEI, we've got the engagement of our chief executive officers in our board and Tom King's leadership of that. So we were able to bringing some of our large investors in, have a dialogue with our board of directors to talk to them about the rising importance of ESG. ESG was always around, but it was always sort of a niche type of investment approach. But what we've seen over the last 3.5 years is that it has become a central proposition to investors and the rating agencies. So on the equity side and the debt side, it's become a priority for the investors, the rating agencies, and the sort of whole ecosphere of the financial community. So we wanted to get out in front of that. We talked to our board of directors about it about 3.5 years ago. They charged us to go and reach out to the largest investors there in our industry in the world. And we had a series of dialogues with those investors and asked them what they wanted to see from us in terms of ESG. And I will say the feedback that we got earlier was, even though all of our companies had been doing ESG reporting, over the years, it had really been sort of driven by the environmental areas in the companies. It was very inconsistent. It was voluminous. It was very hard to compare. And so what the investors said was they wanted something that was clear, concise, and comparable. And they had specific ideas in mind about what they wanted to see for each factor. Obviously, in our industry, the E, the environment, is a big, important aspect. So they helped to define what the template looked like in partnership with us. And we ran a series of meetings. They were sponsored by the banks, the biggest banks, where we brought together 150 plus people, investors, the financial community, and our members. And we essentially negotiated what this template would be and what it would look like. So we were laser focused on the investor needs. And then we brought in the NGOs and a lot of other people in that space, that ESG space. But we felt that if we could meet the needs of investors and had a laser focus on that, that would really be positive for the industry. And the other thing I'll say is that we really strongly felt that an industry-specific approach, a sector-specific approach was the way to go, because some sectors, the E is more important, other sectors, the S is more important, and so on. So we didn't think a one-size-fits-all was a good approach. So we went down that path. And I'm really happy to say that our template is universally being used by the members, and the feedback has been tremendous. And I think pretty much our industry is being looked at as an ESG positive industry. And I think that what this pandemic highlighted was that it's not just the E is important, but the S, and really ensuring that this lifeline service is available to everyone throughout the pandemic was really important, and the industry really stepped to the plate in that regard.
Yeah, just two more questions here, and I think Dave should be ready. Richard, so you talk about the ESG. I just want you to just drill down a little bit into the actual template. Now, is it a static template, or is it going to evolve over time as new issues pop up? Because I know it was released version 1, version 2. So where are we now in sort of the next generation of this template, and what are some of the factors you think could be included, just sort of trying to do some forecasting of the issues in front of us, both
Sure.
environmental, social governance. Can you talk a little bit about the evolution of the template?
Sure, Lawrence. So the template is on version 2, but our goal isn't to just keep adding things onto it, because we really want to keep that concise aspect at the forefront, because it was so important to investors. Because if you're a large institutional investor and you have 15 or 20 companies within a sector that you're covering, you don't want to have to plow through a 70-page document, and that was one of their concerns with some of the ESG materials that were in the marketplace just generally. So we're definitely keeping that concise, that brevity aspect in mind. Having said that, though, we have evolved the template a little bit already. For example, based on investor feedback, there was, from an investor standpoint, we had talked about cyber vulnerability, and everybody recognizes as a lifeline industry and as a backbone of the economy type of industry, as our electric companies are, that the cyber issue is an important issue. But generally speaking, most companies aren't going to put in their financial statements or in their public reports lengthy discussions about what they're doing on cybersecurity, because by definition, that's something that you want to sort of keep confidential, so that those that are trying to attack your systems don't have more information than they need, any more information that you want to give them. So we really addressed that approach by having a dialogue with investors and said, what's the information you really need? And I think that also that they were not aware, as they should have been, of what the industry was doing together to address it, the mutual assistance aspect. So we agreed to a short qualitative discussion of the industry and then some of the company specific aspects in the template, which sort of struck the right balance of addressing the issue, giving the investors the information they needed with respect to, and that's a G issue, by the way, that's a governance issue. Giving them that governance information. And so we put that into the template, and it's available right now. And again, I mean, when we added the American Gas Association and many of our companies own most of the local distribution companies the gas distribution companies. They're usually subsidiaries of our holding companies. We worked with AGA and put together an operating company metric to address methane-related emissions of those LDC operations, because that's something the investors were interested in. And lastly, I'll say that, one of the transitions that we've made on the generation side that has really helped tremendously in terms of driving the reductions that we've seen. And by the way, they've really been profound reductions the industry has achieved over the last, really comparing 2005 to 2018, carbon emissions down 37%. By 2030, expected to be down 50%. By 2050, 80%. Many of our companies have made net zero commitments. But natural gas is a part of that equation. So we're working with the mid and upstream gas companies, extending this ESG idea to something called the Natural Gas Sustainability Initiative, so that they can address methane emissions and methane intensity in a way that helps to inform us and our investors who are interested in that, because we're one of the largest users of natural gas. So that's an example of how we've evolved.
Richard, thank you so much. I'm about to welcome Dave to give his remarks, but before I do that, Richard, I'm not going to let you off the hook yet. One last quick question for you. You mentioned, and we'll get back to the opening Q&A with you and Dave, but you mentioned bad debt. Can you talk about how did EI go about, or what is EI doing to sort of get a good picture of the amount of bad debt that's out there in the industry? Can you talk about some of the approaches you've taken to
Sure.
Develop that understanding?
Happy to do that, Lawrence. As you know, EEI, we work at our board level. We have our CEOs engaged, but we also have committees underneath the board level. And one of the most important committees that we have at EEI is the Finance EAC, which is a committee of all the chief financial officers or CFO EVPs across the industry. That group's been very active and throughout this pandemic to address some of the issues that I described to you with respect to the Fed, the Treasury, and those things. But one of the things that this group did was survey. We've conducted a series of surveys across the industry, and they're month-by-month assessments of past due, delinquent accounts, bad debts, uncollectibles. So we're aggregating that and anonymizing it, but we're looking at it so that they can use that information when they go and talk to their regulators, but also to get a bigger picture of what the impacts have been on the industry more broadly. I think I'll say this, I think we've seen a significant increase based, compared to the 5-year average of accounts that are, delinquent. We've seen that in the data so far. We've only collected for April and May. We'll be collecting, or actually April, May, we'll be collecting June at the end of July, at the middle of July when that's available. But we've seen a pretty significant increase there. And we've seen what we expected, which is that the commercial industrial customers are where that challenge is, and I think the other good news though that we've seen is we haven't seen a big increase in the number of accounts delinquent. So because of, as I mentioned, we have a voluntary moratorium in place, that has resulted in those accounts that have gone delinquent continue to use power, but they haven't been shut off. And so we've seen some increase in that. So we're tracking it very carefully. We have engagement across the industry, and we're really fortunate as a trade group to have all of the companies engaged at that level. And that's how we've done it.
Well, thank you, Richard. You've addressed quite a few questions, and we'll certainly have time to come back to it over the generic Q&A. At this time, I'd like to welcome Dave Turk. Dave is the Acting Deputy Executive Director at the IEA. Dave and I have known each other for some time in the industry, and he's now in Paris, and I wish I were there to enjoy the beautiful weather this time of the year. But Dave, welcome, and we look forward to your presentation. You'll talk a little bit about the IEA recent investment outlook, but also I'm hoping you will cover a little bit your recently released sustainability investment roadmap, if you may, for the energy sector. So Dave, over to you.
Well, thank you very much, Lawrence, for the invitation, and it's terrific to be here with you and with Richard And let me just thank all of your terrific EEI colleagues. The work that you all do domestically in the US and internationally is just very impressive. And a special shout out, if I could, to my former colleague from our Department of Energy days, Daniel Knoll, who was a huge pickup for you guys. And Daniel, it's great to be with you as well. So thanks again, Lawrence, for the invitation. What I'll do in my presentation is try to hit on three main areas. First, I have a few slides just giving the latest numbers, data analysis that we have on how COVID-19, the crisis, is actually impacting energy around the world, but I'll break it up in the US context and some other key regions as well. Secondly, and this will be the bulk of the presentation, focusing on investment in particular. What are the investment trends that we're seeing with that impact in mind? And then third, as you said, Lawrence, I'll pull from a report we just released last week, which is really trying to put together recommendations for governments around the world as they put forward stimulus programs, economic recovery programs, how they can not only increase their GDP, get their economies back on track, also promoting jobs. Jobs is certainly something that's incredibly important in countries around the world. But at the same time, how countries can build towards the future energy systems that they want, the sustainability, the resiliency as well. And we've got some specific recommendations in this analysis that just came out. So let's start, Daniel, if we could, on the next slide. This is just looking again, a few slides on COVID-19's impact on energy around the world. As you can see there, this is looking at the change in global energy demand from 1900 to 2020, so the 120-year period of time. And if you hit the animation there, Daniel, let me see, maybe you've already hit the animation. If you hit the animation there, what you see is a steep reduction. Looks like the slide may have gotten cut off there at the end. But what you'd see is a reduction there going down in the 2020 time period. In fact, what we're predicting based on the information that we have to date is energy demand actually decreases by 6% in 2020. That is the largest decrease since the World War II time period, and in fact, 6 times the difference from what we saw in the Great Recession not too long ago. So energy demand being impacted significantly. If we look at the next slide, let's see how that energy demand is being impacted by fuel. So if you, there we go. So you see coal being impacted in a significant way. That's actually a 9% reduction that we're expecting in 2020. Coal, 8% reduction. Natural gas, significant reduction, a little bit less so for a number of reasons. Nuclear, less so. And then renewables actually is the most resilient of all the fuels that we're seeing. We actually see a slight increase in 2020, although that's far from the increase that we would have seen had COVID-19 not impacted. So renewables being impacted as well. All fuels are being impacted in terms of demand through the COVID crisis around the world. If you go to the next slide. Now let's look at electricity demand in particular and what's happening there. And you see the numbers there going back 50 years in the US in blue, European Union in green, China in red, and then the world in the orange yellow color as well. And as you can see there, electricity demand is set to fall by 5% in 2020. And again, the largest decline for electricity demand since the Great Depression. Impacts largest in the European Union and the US, but they extend to all corners of the world. Next slide. Now, where's that electricity coming from? What sources of fuel are being used on electricity in the power mix? The dynamic that we see here, the red line for coal and the blue line for low carbon, which includes not only renewables, but also includes nuclear, are changing places. 2019 was the first time that we actually saw low carbon outstripping coal. And what we're going to see in 2020 is an increase there and a difference there of 6 percentage points that coal will be behind low carbon in that 2020 time period. So quite dynamic COVID-19 impacts on the mix going into the power side on the electricity side. Last slide from this piece if we could go to the next one, Daniel. And this is looking at the CO2 emissions. With that decrease in energy demand, with transport in large parts of the world being shut down, now coming back online in parts of the world. Although one thing we're certainly seeing with the COVID crisis is different parts of the world are experiencing the challenges in different eras and time periods. But what you see there are the overall numbers that we're expecting for 2020. That is a significant decrease in CO2 emissions, and these are coming from the global energy-related CO2 emissions, which are the vast bulk of emissions from around the world. We're actually predicting that those numbers will decrease to 30.6 gigatons in 2020. That's an 8% decrease overall and takes us back to an emissions level 10 years ago from 2010. So a significant amount of emissions decrease. Now, of course, this emissions decrease is not the kind of emissions decrease we want to see. This is coming on the tail of a huge deaths around the world in many, many countries, and a lot of people out of work and economic recession, the likes of which we've not seen for many, many years as well. What we need is to put emissions reductions on a more structural and sustainable path down. And I'll get to that in the last part of my presentation with our sustainable recovery plan. But before that, let's look at some of the investment numbers in particular. This is the investment picture for global energy that we were expecting to happen in 2020. At the start of the year, our expectations were for modest growth, especially in renewables, upstream oil and gas, and efficiency. This would have been an increase, as you see there from the bars in 2017, 2018, and 2019, a first increase, significant increase, even though it's just 2% in recent years. So that was certainly a good news picture. But what we see now in 2020, if you go to the next slide, is we're expecting a decrease of 20%. So we're going from an increase of 2% that we were expecting before COVID, and now we're expecting that 20% decrease. That's an energy investment gap, if you want to think about it that way, by almost 400 billion US dollars. And as you see from the geographic breakdown there in the colors on the two bars at the right for 2019 and 2020, all parts of the world are impacted. Turn to the next slide, Daniel, if we could. Now this is breaking down that investment hit, looking at the oil and gas, coal, power, and energy use and efficiency on the right, and then the trend lines in terms of global end use spending on energy, consumers, what consumers are spending going forward. What you see if the animation were to work on the 2020 context is the oil red decreases significantly in 2020. Oil, especially because it's so important in transport, not only for cars, but for aviation, decreases significantly. We talked about that significant decrease before, 9%, 8% decrease. Electricity actually overtakes oil in terms of global end use spending on energy for the first time, certainly for in the modern era. And what you see on the right is you see that 32% decrease in investment in oil and gas. Coal, significant decrease. Power, a significant decrease as well, 10%, and of course much larger overall than the coal decrease, even though it's a percentage increase larger. And energy use and efficiency also being impacted in terms of investment significantly. If you go to the next slide, Daniel. So let's look at investment in power in particular. The bars on your left show the total investment comparing 2015 to 2020, and then you see the cumulative changes since 2015 in the various bars on your right. And what you see there is investment in power was also already faltering. We were already not seeing as much investment as we needed to, especially as you look to the gray box, which is grids, and especially in the 2019 context already, and certainly 2020, a significant decrease there in that gray box, which is grids. So while investment in solar PV and wind has held up relatively well, even as the costs have come down, meaning you're getting more wind, you're getting more solar for the same amount of investment you would have had in previous years because of those significant cost reductions. spending on other aspects of a secure and sustainable electricity, power system, grids, storage, flexibility, we're lagging behind, and unfortunately 2020 will be a significant hit in that context. If we could go to the next slide. Now this is looking at it through the clean energy investment lens. And what you see here is trying to break out all those parts of clean energy. So you look at the bottom of those bars, that's renewable transport and heat, renewable power, very significant part of the overall makeup of clean energy investment. Nuclear is the yellow, energy efficiency, the first fuel is there in light blue, and then just a little sliver there on battery storage and CCUS on top there. What you see over time is relatively stable amounts of that investment in clean energy. We have seen an uptick in recent years. And what we see in 2020 is even though the investment in clean energy will go down as the investment goes down more broadly throughout energy, remember that 20% reduction in investment, the investment in clean energy actually goes down less than the investment in oil and gas and coal and other parts of the energy investment spectrum as well. So what you see there with the line, with the dots there, is the share of clean energy investment actually goes up. So below 35% in 2019 context, relatively stable over that last several year period of time, going up to 37% in the 2020 context. So the percentage of clean energy investment goes up, even if the overall investment in clean energy investment goes down. Now, as we'll see in some of our recommendations in the next set of slides, this is nowhere near the amount of clean energy investment in grids, in storage, in a variety of sources of renewables that we need to have to get us to what we call our sustainable development scenario, which is very much our Paris compliance scenario, but also steep reductions in air pollution and achieving universal electricity access as well. So if we could go to the next slide. So that's the problem and the challenge of what COVID-19 is having on energy sector more broadly, and then the investment numbers in particular. Let me just end with a few slides on our sustainable recovery plan. What we've tried to do here with this report, and it's all available, all 172 pages of it on our website, our WEO special report on sustainable recovery is the title of it, is provide recommendations for governments how to, again, boost your economies through spending in energy, how to promote jobs, but also to put the world, your country, but the world on a sustainable trajectory going forward. And this is what we call our sustainable recovery plan. As you see there, electricity and efficiency are the two big players, no surprise, given the importance of renewables and electricity, given the importance of efficiency. And then the red category, a variety of other technologies that are important there as well. And it's a 3-year plan, $1 trillion for that 3-year period of time. If you can go to the next slide, Daniel, let's get into some of the particulars here. This amount of investment leads to a significant amount of GDP growth. The energy sector is important for overall GDP and overall global economy. The additional amounts of investment that we've talked about in the Sustainable Recovery Plan would offer global GDP growth of 1.1% each year over the next 3-year period of time. So significant GDP growth that can happen from smart investments in the energy. You see there that the emerging economies, for a number of reasons, would actually get a bigger boost from this kind of investment than advanced economies. But overall, the world, very importantly. I should mention as well that this report was not only an IEA report, but we worked in partnership with the, as it says there on the slide, the IMF, the International Monetary Fund, especially on some of the economic numbers and some of the jobs numbers as well. We can go to the next slide and we'll look at the jobs in particular. No surprise that in governments around the world, seeing as the unemployment rates have soared, that jobs are the political imperative. And with the money being spent on economic stimulus programs to provide and to promote jobs. What we're seeing in our analysis is 6 million jobs that could be permanently lost due to the crisis. That's the bar there you see in the 2020 significant decrease. The plan that we're putting forward has 9 million jobs in every year created between 2021 and 2023. And you see the breakdown of where those jobs are. Building efficiency, that bright green in the middle, and then the bright blue on the bottom, solar and wind. Again, efficiency and renewables really being the two main areas of investment that do a lot of work, certainly on the sustainability side, but very importantly on the job side as well. And what you'll see in this report is we get very granular on 170 pages worth of analysis, looking at 30 different interventions that governments can make across those areas that you see represented in all the bars there in 2021, 2022, and 2023, including specific jobs estimates of if you do a certain amount of buildings efficiency, here's the number of jobs you get. If you do solar PV, here's the number of jobs that you can expect to have in that capability and that capacity. Next slide, Daniel. Next slide is really looking at grids, the importance of grids, and the investment in grids that we're calling for in the sustainable plan. You saw the earlier slides about the challenge on investment with grids, certainly in the 2020 context. And as you see there, our sustainable recovery plan would boost the spending in grids significantly, a 40% increase. Really not only helping to drive sustainability, but bolstering electricity security, modernizing the grids, enhancing that reliability, efficiency, and flexibility as well. So this is an opportunity for smart government decision-making to step up to the plate and try to, again, build towards the energy systems, the reliable energy systems, the sustainable energy systems that we need going forward as well. So let's look at the next slide. What does this mean in terms of where does this take us in terms of GHG emissions? You see the line chart here looking at emissions increasing from 2005, a slight dip in the 2009 recession. Very importantly there, what we saw is a very steep increase then coming out of that recession. So we didn't plateau, we didn't peak our global emissions. In fact, emissions came roaring back with the previous economic recovery coming out of the Great Recession. That is what we would expect, absent government leadership from around the world, to put us on a different track coming out of this particular economic recession. You see the significant reduction in 2020. That's that 8% CO2 reduction that we looked at in the earlier chart. And what we see here are really two different worlds going forward. The one in brown and orange up top is if we don't have a sustainable recovery, if we don't have governments around the world stepping up to the plate, making smart investment choices going forward to put their energy systems into that more future-oriented world. Not just building back, but building back smarter, building back more reliably, building back with sustainability in mind. If they don't make those decisions, you see those emissions come roaring back, can be expected to come roaring back as the economy gets going again, just like what happened in the 2009, 2010 time period. And then the green band there is really with the sustainable recovery. This is definitively peaking emissions, we would hope, in the 2019 time period, and continuing to drive those emissions down. Our plan in particular reduces GHG emissions by 4.5 billion tons and puts them on that pathway to where we need to reach longer term. So one last slide, just in conclusion. It's really up to governments. The story is not set. We're not on one of those trajectories or another. Decisions around the world, certainly in the US context, not only at the federal government, but at state governments, local governments when it comes to efficiency in particulars, and governments around the world. China's putting together their next 5-year plan. Other governments, Europeans, are putting some significant amounts of funding on the table with their recovery. Governments around the world, the decisions that they make will really drive and shape energy infrastructure and industries for decades to come. There you see some of the numbers with our sustainable recovery plan in particular. Now, I should say the amounts of funding that we're calling for in the sustainable recovery plan are not huge amounts that aren't able to be done. I mentioned that $1 trillion a year for 3 years. that would be less than 10% of recovery plans announced to date globally. So we're talking about quite reasonable, reasonable amounts of funding. And then the last bullet there is what we've been trying to do at the IEA through the COVID crisis is a number of things. First and foremost, what are the numbers? What is the impact COVID-19 is happening across energy? Second thing is providing recommendations. Here's some ideas, taking that analysis of where governments can take things, private sector leaders can take things going forward, again, to have a sustainable recovery plan. The third piece, of course, is implementation, actually getting key decision makers around the world to hopefully step up to the plate and to take advantage of some of these opportunities with economic stimulus programs. And you see there we'll have what will be our most important meeting this year on the 9th of July, what we're calling our Clean Energy Transition Summit, where we have ministers from around the world, including Secretary Bruyette from the US, the energy minister from China, the energy minister, power minister from India, Vice President Timmermans from the EU. In fact, we'll have ministers of energy representing about 80% of global GDP at this meeting. And we hope that'll be an opportunity to drive some of this implementation so that governments can hopefully make these smart, well thought through decisions to, again, provide for economic stimulus, to provide for jobs, but to put the world on a sustainable energy trajectory going forward. So again, thanks, Lawrence, very much for the invitation to participate and be part of this discussion. I hope some of these latest numbers and facts and figures and recommendations from the IEA has been helpful, and certainly very much looking forward to the discussion portion of this session as well. So thanks again, Lawrence.
Thank you, Dave. I should learn my lesson. You should start to unmute before the speaker is done so you don't get caught up in the middle. Let's begin with a few questions, and then I'd like to do it this way. I'm going to ask you, Dave, a couple of questions. And then what I'd like to do then is to see if Richard has one or two questions for you. Now, you missed Richard's presentation a little bit, Dave, so you may not be able to push back or ask him some questions as well. But let me begin first, and then I will see if Richard has a few questions for you, and then we'll take some questions from the rest of the participants. So you talked about the emissions, and you talked about the issue of transport. You mentioned transportation a little bit as one of the reasons we saw significant reduction in the greenhouse gas emissions. In your analysis so far, do you see transportation electrification as a key component of this sustainable recovery plan? What is the role you see transportation electrification playing in this transition?
Thanks for the question, Lawrence. So one thing on the transport side in terms of the impacts that I think is important to note is different parts of transportation were impacted either bigger, more, or less. Certainly air transport was impacted very, very significantly. We're still seeing sharp reductions in air transport, certainly internationally and in many countries around the world. Transportation in one's personal vehicle, cars, were significantly reduced, certainly in the height of the containment measures when all of us, many of us were teleworking from home as opposed to going into the office. Other parts of transportation were not impacted as much. So freight transportation was not impacted as much. Goods still needed to be shipped around the world as well. So we had a differentiation in terms of the impact going forward along those lines. We're also seeing, at least in how societies are acting and humans are reacting, behavioral impacts, both in the near term and then in the medium term, which are quite fascinating to think about in terms of transportation going forward. So one of the immediate impacts, which has some real challenges for road congestion, air pollution, and CO2, is many people are feeling less comfortable using mass transportation, less comfortable getting in a subway, less comfortable doing those kinds of things. We're seeing that in Paris. We're seeing that in Beijing as they open up, in China more generally. We're seeing a lot more people being comfortable getting in their car or buying cars in order to go that way. Now, for anyone who's a transport expert listening in, that'll immediately trigger in your head huge amounts of people on the road, congestion in many cities already a big deal and a big challenge. and CO2 emissions, it's a much less efficient way, of course, for people to get around to use their car as opposed to using mass transit. Now, some people are switching to bicycles. I've never seen so many bicycles here in Paris, which is not always the most bicycle-friendly city. So a number of mayors and other local leaders are trying to figure out how to take advantage of putting in more bike lanes and really trying to promote bicycling or walking and making cities more livable in that context as well. On EVs in particular, electrification, this is really a fascinating time and a real opportunity to further increase EVs penetration into the market. EVs have been on the rise significantly. We just had our latest, what we call our GEVO, our Global Electric Vehicle Outlook, come out just a few weeks ago with all the latest numbers for where the penetration has gotten to in 2019 and our predictions in 2020. And EVs were on very much an upslope in recent years, as you all know, a significant upslope. Now, it's still at a very small base. We're still at about 3% of global vehicles being electric vehicles being sold most recently. But what we've seen is the electric vehicle numbers have held up quite well, even as the vehicle sales numbers have decreased. So again, it's a similar dynamic to what we've seen with some of the renewables compared to oil and other fuels that are impacting in more significant ways. Now, government policy still has a very significant role to play for electric vehicles. Those societies that are seeing the larger rates of penetration for electric vehicles are those that have the incentives, those that are promoting them, those that have the charging stations and other kinds of things. Norway is an example where they have 50% penetration of electric vehicles because they have aggressive policies. China is promoting electric vehicles in very significant ways. Some states and localities in the US context as well. One of the big things that could happen in the stimulus are the cash for clunkers, the trying to promote more efficient vehicles, electric vehicles, or could be more efficient internal combustion engines. And then a lot of focus from certain countries on recharging stations and really trying to build out the infrastructure for electric vehicles in quite significant kinds of ways. So there's a real opportunity for electrification. The trends are already going in that direction. But when you have the kinds of economic stimulus funding being put on the table by various governments around the world, you have an opportunity for that stepwise change in government investment that can really drive the electrification phenomena, including in personal transport.
I want to go over to the Sustainable Recovery Plan for a little bit. So you talk about the 6 million jobs potentially being created. Any thoughts on the skills required in terms of upskilling? Because one of the challenges I would see when I look at the right chart and you see areas like energy efficiency, you have other areas where we don't have the tradition in the industry, if you may, in terms of hiring people. So you have a transition of the energy system. You also need to have a transition of the workforce. Has the IEA given any thought to how we upscale the workers in terms of being able to be prepared to take on these new jobs? You're on mute.
Yep, thanks.
Sorry.
There's two things. I think we're all going to finally get used to muting and unmuting ourselves.
I'll do like Richard. Just keep yourself silent and remain unmuted the entire time.
So there's two pieces I think that are important to this question. One thing is, as we've analyzed previous economic stimulus packages, whether in the US context or other countries coming out of the Great Recession in particular, but other times governments have put stimulus packages on the table. One of our recommendations there, which informs our own sustainable recovery plan this time around, is governments should really focus on what they're already doing, focus on their strengths, focus on the schemes and systems they already have in place, but just supercharge them or put them on steroids. So if you have a scheme for building efficiency, or if you have a scheme for promoting renewables, or doing other kinds of efforts along those lines, do more of that, with the hope that you've already got at least some semblance of a trained workforce, infrastructure in place. You don't have to go through the bureaucracy of reinventing the wheel if you're trying to move quickly to promote jobs and other kinds of things. So there's a part of here that, again, smart government policy is looking at what they've already done, looking at what they're familiar with, and not trying to do big, complicated programs that are going to be very difficult to do along those lines. But certainly, absolutely, Lawrence, to the second part of my answer and to your question is, if you want to have the technicians who can do the solar PV installation, or you want to have the folks who can do the building efficiency, you've got to do the training, you've got to have the incentives, you've got to have those programs to have that trained workforce. And again, at this time period, with the challenges that we're currently having with the unemployment rates around the world, this is an opportunity, again, if governments can step up to the plate, of not only building back, but building back smarter. And part of that building back smarter is to have those skills for the future that allow better jobs if we possibly can. And certainly when it comes to energy and energy efficiency, there's a huge amount of good jobs, better jobs that can be taken advantage of, including to build cleaner energy systems of the future as well.
I have a few more questions, Dave, but I'll go to Richard and see if he has a question for you. Richard?
Hey, Dave, how are you? Before you joined the call, I kind of mentioned the fact that, the EIA just does such a great job of bringing together governments, businesses to tackle some of these fundamental issues confronting the world on sustainability. But, one thought I had just looking at the trajectory that we're on in the U.S. and what's been accomplished so far, which I mentioned in my presentation, in terms of carbon reductions, where, the stationary sources, our sector is no longer the largest emitter. All of that happened when we didn't have a prevailing government policy. All that happened in a large measure because of the fundamentals of what we're seeing in the marketplace, the fundamentals of the technology, the right investment framework, and so on. So to me, I think that's a very virtuous sort of cycle that we're seeing right there. And I guess my question to you is that, you talked a lot about, having government policies in place. And, I guess my question is, maybe it's really a policy that's more focused on incentivizing those decisions as opposed to overly prescriptive, because, traditionally governments aren't necessarily the best deciders on technologies or the best allocators of resources in a broader way. What's your kind of perspective on that? And I agree with what you were saying on the electrification of transportation. That's another huge opportunity. But again, I think that, my personal view is that that'll be driven more by fundamentals and consumer tastes and, just those sorts of things. So I just want your reaction to that. I mean, I think that, this is a real great opportunity to do what IEA does best, which is bring together the private sector and government to kind of tackle these issues. So what's your perspective on those things?
No, thanks very much, Richard, for the excellent question. And I'd say the following, and I agree with everything that you've said. When we look at where investment happens in the energy space globally, and different countries are different, right? Some have state-owned enterprises really dominating what they do, others a more free market system. But as we look at all governments around the world, we can actually track 70% of global investment overall in energy in some way or another, either directly or indirectly influenced by government. So some of that's direct, right? Some of that's procurement or state-owned enterprises or other kinds of things. Mm-hmm. But much of that, in fact, the majority of that is exactly as you suggest, the incentives, right? The rules that governments lay down, ideally in a technology neutral way so that the marketplace can compete, right? Certain technologies can compete. Some will be winners, some will be losers. That's fine if you get the emissions reduction, if you get the sustainability, the air pollution reduction, the affordability, the reliability, and all those kinds of things. So governments have an incredibly important role to provide that fair, competitive marketplace, internalizing some of those externalities and making sure that the market can work, private investment, entrepreneurs can do what entrepreneurs do, coming up with solutions, but all bound within that framework that a government needs to put in place. And ideally having a free and fair marketplace around the world as well, which gets into a whole series of challenges and issues companies are facing around the world as well. And of course, as you suggest, Richard, and this is something, and thank you for your kind words about the IEA, trying to convene government decision makers, private sector leaders, regulators, others together. There's a virtuous, or we hope a virtuous cycle here, right? Government leadership is important. Private sector leadership is important. If companies are stepping up to the plate, advocating for those fair rules that internalize those externalities, then government action can then have the support it needs in order to implement those fair rules that allow the private sector to flourish in that kind of way. And we hope that there's a virtuous cycle. And certainly a lot of that begins with the kind of discussion that we're very proud and eager to help stimulate from the IEA side.
Thank you.
Thanks, Richard. So one question coming back to the sustainability, the Sustainable Recovery Plan, Dave, you talked about $1 trillion. And I'm thinking there's $1 trillion per year, right? Did you guys think about how you break it down? Because $1 trillion is for the entire globe. And so if you split that $1 trillion across the globe, how do you see it, divvying up? It's a 1/3 the EU, 1/3 the US, 1/3 China, or how do you see that sort of it divvying up in terms of getting that amount of money into the system? And then a question for both you and Richard in that regard would be, how do you get the investment community to sort of react to that amount of money that's needed to be brought into the system? What do we need to do? And maybe both you and Richard can reflect on that. So first, divvying up the $1 trillion across the globe. And then second, how do we attract capital to the sector for that amount of money?
So thanks, Lawrence. Thanks for the terrific question. As we said, $1 trillion US sounds like a lot of money. It certainly sounds like a lot of money to my salary. I'd take a healthy percentage of that, which would do me just fine. But in the grand scheme of things, especially as you're looking at this or that economic stimulus program of $3 trillion or $4 trillion or $2 trillion, just in the US context alone, that's not an insurmountable amount of funding, especially for all the benefits that the energy sector provides in normal circumstances and can provide in terms of that job promotion that we talked about earlier on that end. What we look at using our modeling and our analysis is really trying to figure out where's the most cost-effective investment that can happen in country X, Y, and Z around the world. So certainly to achieve these kinds of benefits, it's governments around the world who are going to have to step up to the plate. And very importantly, some governments, like the US government, like European governments, have the ability to borrow and to not print money. That wouldn't be the right way to think about it, but to borrow significantly at low rates. But there are other countries, parts of the world that don't have that ability and are frankly going to be more limited in their ability to have the kinds of robust economic stimulus programs that digs their way out of their own economic recessions. That's where the IMF is important, the World Bank is important, a lot of other mechanisms are important along those lines. There's certainly government investment directly in this $1 trillion, but there's also very much, as we talked about earlier, and to Richard's questions, a huge amount of private sector investment, again, that hopefully will be stimulated by that government leadership and promoted in ways that we need to have all parts of society working forward to achieve our goals.
Richard, you want to comment on the impact
Yeah,
of investors?
I agree with what Dave's saying, and I would just add too. I think that our companies, utilities, are excellent attractors and deployers of really affordable capital, and doing it in a very sustainable way. So I think that one of the things I mentioned in my presentation, and I'll emphasize it again, is that even during the COVID crisis, our members were able to access the capital markets. They were able to issue debt, equity, and so on. I think this trajectory that we're on will continue, so we'll continue to attract and deploy capital. And then one other aspect I would bring to this too is that just given the direction that the industry is going, the sustainable path that we're on, that I think that we're really just right in the middle of the bullseye on these ESG investors, and more sovereign funds, institutional investors, the whole sort of ecosphere of Wall Street is lining up with ESG. And so I think these investments that we're talking about in a sustainable future, generation, transmission, distribution, and so on, all of these things really fit into that. And so I think there'll be increasing pools of private capital available to invest in there. And I would say utilities, from my perspective, are great attractors and deployers of the capital in a way that benefit people broadly. Like, for example, in the transition to the fleet electrification, deploying charging infrastructure so that can accelerate those things, that sort of thing. So I think there's a real great opportunity there.
We're coming down to 12. Well, for us here is 11:30, so we have about 5 minutes left. I just want to probe up two more issues here with David, and a closing question for you and Richard. So one of the things we see in this industry is the importance now of customers. Behavioral economics, behavioral science is certainly one thing we have on the minds. We see on the minds of a lot of customers and citizens around the world. The fear that has been brought about by the pandemic and all the other uncertainty that have arisen because of this. So how do we tell the story about the need for this amount of investment to stakeholders, consumers, and others? Because we're going to be asking society to make significant investments in the energy sector for the benefit of society. So can you and Richard just talk a little bit about, let's humanize this conversation briefly and say, if you were to tell, both of you have kids, so if you're going to talk to your kids about the need for making this significant investments in the energy system, how would you do it? First, David and Richard. So assume you're talking to your kids about making this kind of a investment in the future, if you may. How would we tell that story?
Excellent question, Lawrence. I'm going to steal some of these questions the next time I'm moderating a panel. So a couple thoughts to this. Certainly one thing that makes life both frustrating and enjoyable is the fact that we're not all economically rational robots walking around, right? We all have emotions. We all react to ways that aren't predictable to computer models and other kinds of things. And we're seeing an interesting example of that with some of the behavioral changes that have been forced upon large parts of society: more teleworking, teleschooling, less international travel, et cetera. There's certainly a question that will be answered about how sticky some of those human behaviors are for the long haul, which I think is an interesting one as well. In terms of what resonates, to answer your question directly to customers, especially for the kinds of investment going forward, I'd say a couple thoughts on that. One is there are moments in history where not much happens, and then there are moments in history where a lot can happen in a very short amount of time. And this strikes me as one of those moments in history that a lot can happen. Now, obviously, a lot has challenged us, and this has not been an easy several months for all of us to go through, especially those with loved ones who've been impacted by COVID directly, or those who don't have their jobs, or other kinds of things. But these moments in history allow us to think outside the box and take a little bit of a step back to the kind of day in, day out kind of patterns that we get into. I would hope that this is one of those opportunities to take a step back, think about the energy systems we have, think about what path we're going, what path inertia is taking us to, and really thinking through, is there a better way to go forward with the kind of stimulus programs we're going to spend anyway? Governments are going to spend a huge amount of money digging ourselves out of the economic challenges that we have. Can we do that in a smart way that also builds towards the future in terms of the energy systems that we want to have, to reduce air pollution, to decrease CO2 emissions, to provide where in parts of the world that don't have full electricity access? Are there ways we can be smart about these investments to build towards the future, not just build back to what we had before, but build to the future? For those who are living in very polluted cities, and for the first time in India, they're actually able to see the Himalaya out their windows where they hadn't been able to see that for 30 years. Can we build towards the future that they can see that again going forward along those lines? And then the next thing, certainly I'd say to the kids, I think we need to remember the history going into the COVID crisis, where we saw kids, young adults all throughout the world really clamoring for change on the climate front in particular. And so there's an awful lot of energy, I think, there with kids, with young people wanting to have sustainable societies for their future as well. And that can really, I think, be tapped into in a way that kids marching, kids protesting, kids doing the kinds of things that have been very galvanizing and very inspiring, from my end to say, can continue pushing for the kinds of policies and to keep us, the rest of us old fogies, accountable for what we're doing currently. So I think there's a real opportunity space on that front.
Richard, how would you convince your kids to make the investments?
Well, they're pretty well versed on electric, having come up in my home. I'm sure yours are the same way, Lawrence. But I would say this: I think that electricity and electric is the backbone of the U.S. economy. Okay, and I think that the recognition of that. I mean, the capital spending that we're doing right now is already creating tremendous amount of jobs, over 7 million jobs, direct and indirect, associated with that capital spend. So it's a job creator. And one of the great things about it is that our utilities are in the communities. So those are jobs that are right there and they're visible and seen in the communities. The other thing I would say is that electricity just broadly improves people's lives. Power and energy improves people's lives. It facilitates their lives. And so in parts of the world where they don't have it as much, bringing it is going to be a huge step improvement to people and their lives across the board. And then I think it will also facilitate things we were talking about: electric transportation, futuristic autonomous driving, trends like that are probably on the horizon that will maybe even address some of the concerns that Dave raised about, people turning to bicycles. Maybe they'll feel more comfortable with getting into an autonomous driven, Uber or something like that. With respect to telework, I have mixed, having gone through it now for about 3 months, I have mixed feelings about it. I'm looking forward to getting back to the office, but I think we've been extremely effective, and the electric industry has enabled that for society. It's enabled that transition. Yes, there's a lot of people who've been very negatively impacted by this in terms of their jobs and those impacts. But electric, in so many ways, has enabled the economy to kind of continue to march forward. And so that's really demonstrated that throughout. I don't know that, personally, I think there's a lot of benefit to going to meetings, particularly at IEA in Paris, big benefit. but I do think that there will be some changes that are sticky from this, and I think electric and electrification will do a lot to facilitate making some of those permanent that the marketplace and society feels are beneficial.
Well, listen, it's almost 11:30 or almost there. And to end, I'm going to ask each of you one last question. Two-part question. You can give very, very short answers to it. So the question is, and we'll start with Dave, as we look at the recovery, as we look at reopening, as we look at society moving forward, can you tell us what excites you the most about the future going forward, in the future of energy or investing in energy? So what excites you the most, and what concerns you the most? And the same for you, Richard, after Dave. What excites you the most about the future going forward? And then what excites you the most? So start with Dave.
Well, thanks again, Lawrence and Richard, for having me here, and Daniel as well. And we look forward to having you come out to Paris as soon as conditions allow. Completely agree with Richard. There's nothing to replace the human touch and getting together in person with people in 3 dimensions and not just looking at computer screens all day. I'm not sure that's good for our eyes or our brains for that matter. So looking forward to seeing you guys in Paris soon. So what excites the most and what concerns me the most? I'll take the concerning one first. What concerns me the most is just inertia and the challenge of making change at the pace and the scale that we need to, not only to avoid the worst consequences of climate change, but to get the benefits of electricity, the benefits of energy to everyone around the world. Richard, I thought you put it incredibly well about how much electricity brings to the table to educate us, to power our health centers, our hospitals, to provide entrepreneurs around the world opportunities that they wouldn't have otherwise. we need to have that. Sometimes we say energy good, emissions bad. Energy is good, electricity is good. That powers our modern societies. And my biggest concern is we just need to make change at a pace and a scale that's so much bigger and faster than what we've been able to do previously. And it's just a concern that modern societies aren't going to be as fast enough. And we're going to realize, boy, we wish we would have done things 10 years ago or 20 years ago, et cetera. And I'm concerned that that we collectively will have some of these regrets. And again, you know, that's what concerns me. Now, what's exciting about the future is a bit of the flip side of that, and that I do feel like over the last several years that a number of people around the world and in our societies are taking a bit of a step back. I think crises sometimes force us to take a step back and to think of the big picture and to think that, well, I never thought I'd spend 3 months teleworking and being holed up in a Parisian apartment with 3 kids. We did it. It wasn't pleasant all the time, but we got through it. But those kinds of situations, I think, allow you the flexibility to think outside the box a little bit and to think, okay, we can do things a different way. We can control things. We are smart. We have technology. We have the ability to impact human behavior in very significant ways. So if societies get their act together, if people around the world demand action from their governments, their investors, their companies, I think we can actually make the kind of changes that we need to again, reap the benefits of energy and electricity, but to not have the harm that comes with it. So I'm actually excited about that dynamicism, certainly coming from the youth, but others of us who aren't as young as we hope, as we wish we were when we wake up in the morning and it takes us a few minutes to get going in the morning. I actually think this offers up a dynamic opportunity for us to collectively and individually step up to the plate.
Thanks, Dave. Richard, you get the last word.
Thank you. I'll just build on Dave's great vision. I think one of the great aspects of this is that electricity is at the sort of epicenter and heart of the sustainable future. And I think that provides tremendous growth potential for the industry and also in areas such as electric vehicles and transportation, tremendous opportunities. I mean, I don't think I want to be the first one flying across the Atlantic in an electric plane, but in terms of other parts of electrification, electric transportation, tremendous opportunity. And then I would say, that the pace of change will be so fast and profound that I think the challenge and the worry is that the rest of the world, maybe that we bring everybody along as we deploy this new future. And I think that, I think the capabilities there, and I would just compliment IEA. I think they're one of the great agencies that can do just that can bring everybody along together and get that coordination and help to focus that effort so that not only do we have this quick acceleration into the future and this electrification, but that everybody can benefit from it.
Well, thank you, Richard. Thank you, Dave. This has been a very, very interesting and very, deliberate conversation around a topic that I think we'll be revisiting over the next couple of months as the reopening occurs. So I would hope that over the next maybe 6 months, I can bring the two of you back on another call and to really see what we've done and what has happened so far. And you notice I didn't ask you guys to predict because I don't want you all to be on the spot of making predictions that won't come true. So I didn't ask you all to predict, but I certainly really have enjoyed this conversation. And Dave, certainly I look forward to visiting Paris soon, and I'm sure Richard does as well. So again, ladies and gentlemen, thank you so much for joining us. This has been perhaps the longest webinar I've had, 90 minutes. I thought I wasn't going to make it, but it was actually very, very easy to do. And we could actually continue for another half an hour if we had the time, but we'll not do that. So let me turn it over to Daniel Knoll, who will just inform you as to what's the next step in case you would like to listen to this webinar again or get more information about the EI International Program. Daniel, over to you.
Well, I'll be brief. We'll send the recording and a copy of the slides out to everybody today, and that'll include also a way of getting in touch with us if you want to be informed of future webinars. So thanks to everyone, and have a wonderful rest of your day or your evening.
Thank you again, and bye-bye, Dave. Bye-bye, Richard.
Thanks, Lawrence. Thanks,
Thanks,
Dave.
Lawrence. Thanks, Richard. See you guys in Paris, hopefully soon.
Hopefully soon. Okay.